Well, good evening, everybody. It's Blair Nightingale. It is time for the next installment of our latest series. We're talking advanced options. Last week, we did the same thing. First time we did debit spreads. Had a good crew on here learning what is a debit spread, because we can talk on this channel about how cool options are. Here at Tradeway, we spend the large majority of our focus talking about, looking at, and learning to trade options. In many cases, I was just with a crew of almost 300 people in Orlando this past weekend, and a lot of them had never even really heard of options, right? So I know there's lots of people who might even hear me now saying options. You're joining us live. You might be watching this on recording. What are options? I came here because I want to learn how to trade stocks, or I'm interested in learning more about trading stocks. Maybe you've heard that the market's at a discount. Maybe you've heard that the market might crash. Actually, in some measure, it has already crashed in 2022. Is it going down further? It seems to be coming back up. Is the bear market over? These are all really good questions. Maybe you only have one of those. Maybe all of those are questions you've been asking, and that is why you are here. Well, I've got good news for you, because we do Market Monday every Monday. Every Monday, we're coming on this channel to tell you exactly those things. In fact, we've done a series prior to our advanced options, which we are now in, as I mentioned, where we looked at the bear market crash. How far can we go, right? Where do we expect it to turn? When will we know? Can we know? These are great questions to ask, and we've dove right into those in previous series here on Market Monday. I say that because I want to set us up for tonight. And I also want to address the many people who come and watch this show, again, both by live or by recording, to say what I'll say probably every time, right? Especially in this series, that you can always go back. And I highly recommend going back to any older episodes that you maybe have missed. Okay, maybe you're just joining us. So you didn't miss it in one sense because you didn't know we were here. But you can always go back and you can see it right there on YouTube. You just go Tradeway. Go Tradeway on YouTube, and you can find all the episodes here. I like to say this because I hope that this is very helpful for you, to say that when you string all the Market Monday episodes together, there's a lot of really great information for you to start to feel like you have an idea of what the markets are doing and what's the potential of what you can do in the market. And of course, that's a big part of the series that we are in now, which is advanced options. So if you don't know what an option is, you can always go back to those previous episodes. Last week, we did our first episode of this series, Advanced Options, and we talked about the debit spread. Now, there's two terms there, isn't there? Debit and spread. And so in the course of that episode, I showed you, well, what does the debit mean, right? And in short, it's that you and I are still going to pay to get into the trade. We're going to do an options trade. We're going to buy either puts or calls, the two kinds of options that are out there. It's only two kinds of options. Lots of things we can do with those two. I'm going to show you another way tonight. But puts and calls, right? Calls make money when the stock goes up. Puts make money when the stock goes down, okay? And as we combine, right, buying and selling, we can do some pretty interesting things. But the debit spread is what we went over last week. I want to go over something tonight. And while the debit spread is powerful, the reason I didn't start there is twofold. One, I wanted to give you a preview of what I mean by spread. We talked about that last week, because I'm actually going to do two options at the same time now. That's the spread. But I didn't start with the credit spread, because the credit spread is revolutionary. And I have that. I literally have put that in my notes for tonight. But I actually mean it with all authenticity. I mean it with all excitement, because it is actually revolutionary. And let me just say this. Most professionals, most professional option traders, now I think it's fair to say not all, but most use this strategy or a variation of this strategy in their professional trading. In fact, you might say they actually primarily use these. Okay, now not all, but most. You say, well, wait, why? Well, I'm going to show you what the strategy is, of course. But tonight, I'm going to show you what it means to sell options and make money. Normally, you and I have been used to buying options, buying a call, and the call makes money when the stock goes up. Buying a put, and the option makes money when the stock goes down. Buying a stock, and we make money when the stock goes up. You buy something, you have a directional bias, and if you are correct about that bias, then you make money. That's the foundation for most people when it comes to trading. You may know how to do stock, buy it, goes up, make money, goes down, lose money. Then you add in options. We can make money up and down with options now. And then last week, we looked at the debit spread, an interesting way to buy and make money when it goes up, or buy and make money when it goes down, just like calls and puts. But we added a little variation in there for some special advantages. We talked about that last week. What I'm going to do tonight is actually jump beyond buying. And this is the big jump. And I always say this to our students, we call this step 3 in our program. Okay. We talk about credit spreads in our third, you could say, part or unit of our program. Okay. And it's our step 3 credit spreads. And I like to tell people the jump to credit spreads is typically the most revolutionary. And in some ways, it's the bigger learning curve, because if we're not familiar with selling options, which I'm going to explain tonight, then it can be a little strange at first, because it's a concept that maybe we've never heard about. I can see some folks are just joining in here. We got more people coming into the class as we're going along. Welcome, 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 welcome. As you guys know, I love to see your names in that chat box. Comments, questions, anything that you want to chime in with, please don't be shy. YouTube, Facebook friends, light up that comment box. Let me know what you're thinking. We are going to pull up some charts just like this as we go through. So just know we're going to go ahead and actually talk for a little bit about what this is, why traders are interested in this, and then I'm going to show you a little bit right on the chart of what a credit spread really looks like when we go and we get into the actual market. So I'm going to pop that off the screen for now, but just know, of course, we're going to go back to the charts. Janet is with us again. Janet's 2 in a row now. Thanks for being on again, Janet. Love having you here. We are going to dive into this. So first of all, using options, and I've laid this out a little, using options, period, is a game changer. Now, there's many reasons why I believe that is true, okay? But we have a flexibility of what we can do with options that you simply don't have with stocks. Doesn't mean that trading stocks isn't appropriate, right? It doesn't mean that it's somehow lesser, but there are things that options can simply do that stocks simply cannot do. And I want to expose for you in this series what some of those things are, because these things could be things that you could be using. And I've quoted this many times this past weekend. As I mentioned, I was with almost 300 new traders this past weekend. And they asked me, wait, if you can do this kind of stuff, how come other people aren't telling us to do this? How come we're not learning about this everywhere, or at least in more places, right? Which is a very valid question, because why do they ask it? Because it could be so life-changing. It could be such an amazing way to put your money to work, right? And what I'm going to show you tonight is putting your money to work in the market in a way that you probably have never heard, okay? And I tell these people it's simply because a lot of people don't know how to do it. They just don't know that these things exist. They just don't know what they can do for us. But you tonight, you're going to know. You're going to know. So that's our starting point here, okay? So we did the debit spread last week, and we did two options at the same time. Well, tonight we're going to do the same thing, but we're going to change it up a little bit, okay? Credit spreads, as I mentioned, they are a game changer. And I mentioned most professional traders employ this strategy or some variation of it. Why? Because what I'm going to show you is something that is a higher probability of making money than directional trading in most cases, right? In most cases, there are ways to do credit spreads that we don't teach that are very, very high risk. And that doesn't really help you, right? This is a preview of what the credit spread is and what it can do. Of course, learning to specifically apply it in a healthy and consistent way in the markets is something that we're at Tradeway doing with our students every single day, okay? A 30-minute session on YouTube is going to give you a lot of good information about what it is and why it's something you should have in your arsenal. However, we're going to go through a whole lot more training to dial this into a consistent approach. But statistically speaking, when I set these up in my brokerage account, it tells me the percentage, right? The percentage, the probability of profit. And these are higher. Now, let me just think about something. Let's pull this up for a second here. Let's go here. Now, let's think about how we normally do a trade, okay? So I saw actually this stock today. I like this. I like this guy. Okay, looking at Costco. A nice looking trend here. Comes down to the 10-day today, starts to bounce up. The market hit, I'll just show you here just for, right? This line right here, you notice these highs back here? We opened in the morning looking like, oh, we're finally going to break through that rim. And not quite. The strength isn't there. So end of the day, it pulled back. And you can see that reflected here in Costco. But this is a pretty nice trend. So let's just take a look at this. So you would come into this guy and you might look at it and you might say, all right, I like Costco at the 10-day. And I'm looking at potentially buying because I have a bias. Well, why? Well, because of the pattern, because it's at support, potential support anyway. We'll see if it holds. So I could buy a stock, right? I could buy a call. I could buy a debit spread. And in all of those cases, I want the stock to move up. Right? That's a bullish play. I want the stock to move up. So what I need to do, and this is just going to state it simply, right? I get in and I need the stock to move in one of two directions. If it moves in one of two directions, I make some money as long as it moves enough, right? And in the case of the debit spread, it has to move enough fast enough. But if it moves down the other of two directions, right? If it moves down here, then what happens? Well, obviously, then I lose money. So you say, okay, buying is 50-50. Now, we're going to show you, in fact, I am showing you right here on this chart, there's a nice, beautiful uptrending pattern, right? We're beginning to look at price, and then we add in some other factors as we learn in the program, how to look for momentum, right? How to look for signals. It's not knowing the future. We're just looking at the signals in the market that tell us this is a much more bullish stock than bearish stock so that I can slant the probabilities in my favor. So in that sense, when we apply the system and we're doing a directional trade, it's not just 50-50, okay? We're looking for as much momentum in our direction as possible. However, purely speaking, it can only go one of two directions, right? And if it goes the other direction, the one I don't want, then that's where I begin to take an expense, right? And of course, I can keep expenses small, stop out of the trade, and live to trade another day, which is actually a normal thing for a trader, right? I told somebody this weekend, in order to be a good trader, you have to learn to be a good loser, okay? If you haven't seen some of our episodes on stopping out, right, limiting losses, that's something to go back and check out, and you'll know what I mean. But if you want to be a good trader, you're going to have to learn to be a good loser. Now, that said, what's the whole point? What does this have to do with credit spreads? Well, our paradigm, the way we typically look at the market is purely directional. The stock has to move one of two directions or I can't make money. But the credit spread does not work that way. The credit spread works totally different. And think about this as well. When you're considering an option here, okay, remember options are contracts and they have time limits on them. The contract might be for a week. It might be for a month. It might be for a year. We can buy different terms. We talk about this in the program. If I go to the option chain here, look at all the expirations I have, right? I can buy an option that lasts till August 19th. I can buy one that lasts till September 16th. I can buy one January 19th, 2024 if I want to go out that long, right? Stock, if I own it, I just own it and I keep it for as long as it exists or until I sell it. Now, options expire. That's a difference, right? That's a different part of options. Now, I'm going to uncheck these here. Because they have time and over time, right, the value of the option is going to go down a little bit. With every passing day, the value of the option is going to go down a little bit. Why? Because part of what you and I pay for in an option is the time the option is in effect. Well, if the time is passing by, then some of what I paid for is eroding. So options, when they're directional, aren't purely 50-50, are they? Because not only is the direction in play, I've got to see it move in my direction to make money. It also is having some of what we call that time decay. So that puts us in a spot where sometimes buying and being a buyer of options puts us in a little bit of a hole. Now, buying options and being right on direction can produce the biggest and best returns. We have to take on a little bit more risk, in some cases a lot more risk to do that. And we can do that because we can learn a system that helps us manage that risk, which, by the way, that is the job of a trader. The job of a trader is to manage risk first. And when you're a good risk manager, then you're a good profit manager. So we put that first. But selling options brings us into a whole new world. And the credit spread is one of the ways we look at getting into that world. So when we think about directional trading, the first thing I need to lay out here is it's not the only way to trade, right? Using an option to know the direction of the stock is not the only way to trade. Not anymore. Remember, I said this is a little revolutionary. This is a little bit bigger of a jump in understanding for a lot of our students because, again, I'm leaving behind me paying for something that needs to go my direction. You're saying, well, it's not really helping me, Blair, that you're telling me that, but you're not showing me what the credit spread really is. I'm laying the foundation here, but that's exactly right. That's exactly what we need to do. So I have a little disclaimer here. At some point, we're going to have to accept something about options, okay? Wall Street will let us sell something that we don't own. People will ask me all the time, how can you sell something you don't own? Wall Street will let us do it, right? For those of you that are familiar with shorting stocks, it's a good example. Now, we're not talking about shorting stocks, which I'm not going to go into here because we're focusing on options. But shorting stocks is essentially a strategy where I'm going to borrow stock that I don't own and I'm going to sell it as I seek to profit from its moving down. Okay. It's a strategy that has unlimited risk. You can lose more than you put into the play, right? We don't teach that. We teach something much safer, primarily put options, which we've covered. But the credit spread is a selling to open strategy. Meaning the reason I call it a credit spread is because when you go do a credit spread, we're not actually going to pay for that trade. Okay, now we may pay a commission to the broker to do the transaction, but when it comes to the option itself, I'm actually not going to pay for the option. I'm going to get paid for the option. Well, who gets paid to open the play? Somebody who sells something. In every other case that I've mentioned tonight, I'm buying, but the credit spread is not primarily buying something. It's actually selling. Now, I want to introduce this idea. We need to understand where options came from. The fundamental level options came from is for stock traders to have some kind of an instrument in the markets for them to be able to insure their positions. Okay. Mark Cuban did this in the 1990s, right? He sold one of his companies to Yahoo for billions. I don't have the exact number. You guys could Google it. But he sold it for billions and billions of dollars. But one of the stipulations in the deal was that he could not sell the stock that he got. He sold the company to Yahoo. So he was paid in part, in large part actually, he was paid in Yahoo stock. But he couldn't sell the stock. So think about this. What if you get paid with a whole bunch of stock? Let's imagine this was you. You get paid with a whole bunch of stock, but you're not allowed to sell it for a certain amount of time. Wouldn't you be a little concerned that you might lose money in the stock? What if the stock starts going down, but your deal says, sorry, Janet, sorry, Benny, sorry, Blair, you can't sell it, right? I want to make sure I get your name right. Restinsa. What if you can't sell it? Well, what if you could insure it? What if there's a way you could insure your stock? Well, that's fundamentally where options started. Now, options trading has become something where people don't even pay attention to the stock. They just want to trade the options now. But in the beginning, the idea of a put option was that you could insure a long stock position. If I have stock and I don't want to sell that, I don't want to liquidate that stock, you could sell puts, right? Excuse me, you could buy puts. You could buy puts. And as your stock loses value, your puts would gain in value. You say, well, how do I make money doing that? That seems like I would come out net zero, wouldn't it? Well, it depends on how you do it, but yeah, and that's the idea, right? The volatility of the market, if you did lose value, right? If Mark Cuban lost a lot of value in Yahoo, which by the way, Yahoo lost a huge amount of its value during that time. But guess what he did? He bought put options, right? He bought a lot of put options. So he used it as an insurance contract. If somebody had a short position in stock, meaning they expected the stock to go down and they wanted the stock to go down, then they would do the same as Mark Cuban. It's just the opposite side of the trade. They would buy calls to insure their short position. Because if the stock goes up, which a short seller does not want, right? A short seller wants the stock to go down. Then he could buy calls. And as his short position is losing him money, the call options are gaining in money. It's an insurance contract. And that is where I see you there. I see you guys. All right, awesome. Glad to have you guys on here. As one is losing, the other one is gaining. And that's where options come into play. And it's important for us to understand that tonight, because if you think about insurance, which is what I just explained, imagine this. Imagine everybody out there is probably, you own a car, you're a homeowner, you've insured your iPhone, whatever it is. I mean, you can't drive and not have car insurance, right? So we all are familiar with what it means to have insurance, health insurance, you name it. Well, as a buyer of health insurance, as a buyer of insurance on this guy, right, I get coverage that I pay for. And I own the phone or the car or the home, whatever it might be, whatever the asset is, you're buying insurance on it. And someone else is selling the insurance. Now, the person who's selling the insurance doesn't own the asset in most cases, right? I own my car, right? My insurance company doesn't own my car. I own the car, but I pay them and they sell me insurance. So they are on the other side of that trade, aren't they? They sell insurance and they get paid for it. And how often do they get paid? Well, it depends, but in most cases, every 30 days. When I'm an option buyer, I'm buying some insurance for a certain period of time. But when I'm an option seller, I'm just collecting some premium. You pay premiums. Insurance providers collect premiums. And what happens is, if there's no claim on that insurance, they simply collect the premium and next month they sell you more insurance. Because what you've done is you've bought insurance. In most cases, we could pay it a year ahead of time and things like that. And sometimes we do. But basically, you've bought insurance at a monthly basis, and they're happy to sell it to you on a monthly basis. In fact, they like when you don't make any claims. You and I probably would say the same. We don't like when we make claims either, because that means something's happened, something's gone wrong. We love to have the coverage, but it also sometimes is a little bit of a bummer paying premiums when we don't seem to ever make a claim, but we want to have that coverage anyway. Well, they're happy to collect that premium. Options traders think a little bit like that when they begin to sell options. They just want to sell some contracts, some coverage, and collect that premium. Now, again, this isn't a full course on credit spread selling, covered calls, some of the different things that we do to collect premium in the market. But it is a very important thing to understand before I show you anything else, because you have to understand what it means to be an option seller and why anyone would ever do that. If I go into the market and take an option and sell it, I'm going to collect money right away. It's going to go straight to my account. In fact, when I get in the trade, I'll know how much they'll pay me for that option before I even get in. Okay? And then if certain things happen, I'm going to show you, right? Then I get to keep all that money. And then what ends up happening is it unlocks in my account. It's credited to my account, but I can't spend it until that contract expires. Once that contract expires, then I'm able to keep that money. Okay? Now, there's something about this that's really, really cool, because now if I'm a seller, my primary concern is not that the stock moves in my direction a whole lot. My primary concern is that the time goes by. My primary concern as an option seller is that time passes so I can collect some more premium. I want time to pass without a claim being made, so to speak. And that's part of learning to safely trade these kinds of strategies, is understanding, well, there's risks in every strategy. So what's the risk of the credit spread, right? But primarily speaking, I just want the time to expire. So here's how I would liken this before we go to the chart. You guys might not necessarily know what it looks like to trade a credit spread yet, but you probably have an idea of what it's like to own a home, and maybe you Airbnb that home while you're away. You still own the asset, the house, right? But you can rent it out to somebody for a period of time and they can pay you, right? Well, what if we could do that with our stock that we own, right? If we own a good amount of stock, we could do that with something called a covered call, right? That's a covered call strategy. In fact, if you have a brokerage account, they've already given you privileges to do covered calls. That's how safe they consider covered calls to be, right? I talked to an 84-year-old woman yesterday at the event who wanted to learn to trade. And in her age group, obviously, the finance and investing world would be, very, very cautious and careful that particular demographic, which tends to be vulnerable, is really taken care of. And the rules and regulations and laws in the stock market are in place for that reason. Well, they Wall Street, will allow an 84-year-old woman, God bless her, to trade covered calls, which is selling to open. Why? Because they consider it very, very safe. So I want to flip the brain here where we're going, all right, whatever Blair's talking about right now, I'm not going to pay money to start this trade. I'm going to get paid money to start this trade. What I'm actually going to do is I'm going to sell a call and I'm going to make some money. It's going to put it right in my account. I'm going to sell a strike price in a call. Could be a put, but I'm using calls as an example first. I'm going to sell a call, and then I have to recognize that just like shorting stock, if I just sell a call when I don't own the stock, it's not a covered call. It's what we call a naked call. If I only sell a call, then I have tremendous risk. So what I'm also going to do is I'm going to sell a call and I'm going to buy a call as well. Right? I'm going to sell one out of the money and I'm going to buy another one even further out of the money. Why would I buy another one? Because I'm going to get paid for the one I sell. Let's say I get paid $1. Well, it'd be nice to make $1 per share, right? But if I have unlimited risk, I'm going to want to do another leg on there as insurance. Because if I buy a call, what does a call that I buy do? It increases in value as the stock goes up. So if I have a call that I sold and made $1, and then I bought one, and the one I bought made me, let's say, it cost me 40 cents. Okay, so I made $1 because I sold, but I had to buy some insurance as well. Because if this thing gets away from me, I got to make sure I have some insurance on there, right? So then that one cost me, and in the end, I made a 40-cent net credit. I sold something, but then I also bought something at the same time. Now, let me show you what this looks like visually speaking. As I go to the chart, let me pull this up for you guys. Okay. Using the example I just said, okay, if I sold a call right there, let's say this is a high dollar stock here, but 560, right? $560 strike call, I sell it. I'm going to take, and I'm just making up numbers here, guys. We could go into the option chain and look at exact numbers, but let's just say I make $1 on that. Okay. I make $1 per share. And remember, I'm selling an option, which is for 100 shares. Okay. That's a pretty big credit, but it's really easy math. But if the stock goes up past that, then my call, remember, I sold it. I didn't buy it. When you buy a call, it makes money when the stock goes up. When you sell a call, it loses money when the stock goes up. So that's why naked calls are super dangerous. Your broker won't let you do them. I'm willing to bet that 99.999% of people that are going to watch this webinar don't have the privileges to do naked calls. So I say that because I don't want you to worry like, ooh, what if I somehow do it? Your broker won't even let it happen, right? They won't allow that to happen in the software. So no need to worry there. But I'm going to have another leg on here, right? And maybe it's $10 higher, right? But that one I'm buying. Now, because it's further out of the money, it's a call option. It's not worth very much. So we have to understand options here. That means that if the stock, all right, and this is what I really want you to get tonight. In fact, if you don't get anything else that I talked about tonight, this is the most important thing right here. So I'm not being cheesy. Like, are you ready? Are you ready for what I'm about to say? Because this is the most important thing I want you to understand. If this stock stays below this line, right, stays below this line when this option expires, okay, I get to keep all the money. I bought one for $1. I sold one for $1. I bought one for, what did I say, 60 cents, right? Or 40 cents I bought it. I think that's what I said. So I bought one for $1. I sold one for $1, bought one for 40 cents. That means I keep 60, right? I keep 60 cents. If this stock after the next, let's say a month, right? If our options are going to expire in a month, if it stays below that, it doesn't matter if it goes sideways. It doesn't matter if it drops all the way down to here. It doesn't matter if it doesn't even move for 30 straight days. It doesn't matter if it comes up all the way to here. If at expiration it is outside of that line, I make max profit on this. So that's the most important thing. You may not quite understand where I'm going with some of the technical pieces of this, because this is a little bit more complicated of a jump for sure, right? That's why we have whole courses on this. But I want you to understand that there are strategies where I'm not dependent on it moving my direction. There are strategies that are dependent on time, and the stock can do pretty much anything. It does not have to move. And every other strategy we've covered requires the stock absolutely has to do this one direction or I can't make money. That's not true in the credit spread. Now, I want to highlight something. This trend is going what direction? Well, it's going up, right? So I don't want the stock to get into the box. I want it to stay away. It can go anywhere down here, but I still want it to stay away from the box. So what if instead of doing calls, I do one of these boxes, which is a credit spread, and I actually do it down here? Except instead of doing calls, I do puts. I sell a put here. That's the one I make money on. That's my credit. And then I buy a put here, and that's my insurance. It means I can't lose. I'll lose some money, but I won't lose a lot of money. Because if this one, what we call my short leg, the one I make money on, the credit, starts to lose money, it can only lose money until the other leg kicks in. Okay, that's how a credit spread works. And since this trend bias is up, the stock can go, it doesn't matter to me if this stock goes to 6,000, but it doesn't have to. If in 30 days it's at 541.90, I don't care. It doesn't matter. I'm going to make max profit on this trade. It can go all the way down to 520. It could even go down to here, 511, 510. That doesn't matter. As long as it stays out of the box and doesn't cross over, I make money, right? You would make money. That's how that works. Now, again, there are risks to every strategy. There are risks to credit spreads, but statistically speaking, do you think it's a higher probability that I'll make money picking the direction of a trade? Or perhaps would I have a higher probability of making money if all I need the stock to do, it can go anywhere it wants, except it just can't go this far down. It can go down, it just can't go that far down. It can also go sideways. It can go nowhere. It can go up to 1 million. Doesn't matter. Statistically speaking, because it can move 3 directions, up, sideways, and even some down, and I still make money, that raises the probabilities of the trade. I don't have to pick direction. And this is why professionals learn to trade options. Remember, I said, if you're a buyer of an option, what's happening a little bit every day? What's happening a little bit every day? Right? You're losing a little bit of the value you bought in that insurance contract, that option contract. Why? Well, because you bought time and the time is passing. So we lose a little bit of that value. Well, as a seller, that's good. That's good. I sold 30 days of time, and let's say there's only 8 days left, right? Well, they can't cash in time that doesn't exist. So I get to keep that money, which is what I want. That's ultimately what I want as an option seller. I just want it to expire. And that's all the insurance companies of the world want. They want to sell you and me a term contract, whether it's 30 days or 2 years or whatever it is. And they just want to collect that premium and never hear from you and me again. That's what they want. So when stocks are going completely and totally flat, it's kind of a bummer to be a directional trader. I can tell you, it's a bummer to be a day trader when there's no direction. You can't make money, right? When you're a swing trader and you're buying stock and the market's just flat, or it's a little bit forward, and then the next day it's back, and then the next day it's forward, and then the next day it's back. It can be very frustrating. You might find, man, I'm stopping out of a lot of plays because I keep picking a direction and the market doesn't have a strong bias. Now, when the market has a strong bias, it's great to be an option buyer because the market's moving and it's moving with conviction and it's moving with consistency. And it's not just 1 or 2 days in a row, right? You're getting huge bull runs and you could be doing credit spreads. But since the market's doing the same thing a lot of days in a row and really running, you might say, geez, I think I could be making more money if I actually bought stock or bought call options, right? In the case of a bull market. And that would be true. And you're going to make better returns. That's the last thing I'm going to say about the credit spread here. What's the trade-off for a higher probability of profit here? Remember, I said it could go all the way up. It can go all the way sideways. It can even go some down, and I still make max profit on this at expiration. What's the trade-off? I'm not going to get paid as much to sell insurance as I will get paid if I bought calls and the stock does go my direction. There is a payoff for choosing a direction and being in the right place. There is a payoff for that. But the downside is that if the market's not moving directionally, it doesn't work very well. The other downside is that you have to pick a direction, right? You have to pick a direction and you really don't know which one it's going to be. Now, when you learn the Tradeway system, you learn how to take only the best opportunities. But because we are holistic traders and we understand the benefits of options, we also include something like the covered call and the credit spread so that you and I understand we don't have to be trading directionally. Some traders out there, this is going to be their bread and butter, right? They're not really going to do any directional trading. In fact, some traders never do directionally biased trading. They only do these. Right? They like the probabilities, right? And they can set them up very conservative. They make lower returns, right? You can leverage these trades just like any trade, but they tend to make lower returns than a directional trade would make. But if it's more consistent, then maybe that's the way they want to go anyway, right? Either way, Tradeway helps you discover what's my sweet spot, right? How do I develop a trading plan where I'm doing a little bit of the directional speculation, but I'm also adding some of this insurance, right? Adding some of this, what we like to say, selling premium. Because isn't that what an insurance company does? They sell insurance and they collect premium. Covered call traders are, in one sense, almost collecting rent. And credit spread traders are collecting premium. It's the same thing in some ways, but a little bit different because in one case, you own the stock, but with a credit spread, you don't need to own the stock, right? That's why we buy the insurance leg, because you don't own the stock. You say, I don't know if I really get this whole thing yet, Blair. It sounds cool. I like the higher probabilities. It just has to stay out of the box, but I don't think I know how to go do this on my own yet. I don't expect you to know how to go do this on your own yet. I expect you to look at this and go, wow, there's some things I can do with options that I didn't know I could do. And I could make some pretty nice returns for a much lower amount of risk where you don't have to have some of the anxieties of going, geez, is the market going to move my direction tomorrow or not? Well, as a credit spread trader, while direction does play a factor, it doesn't play as much of a factor. In fact, in some cases, it doesn't play nearly as much of a factor as doing it in a directional fashion. Janet says, I finally understand it, right? I finally understand it. Hey, that's what we want to hear. We want to hear the light bulbs going off, clicking, and understanding that there are different things I can do. And here's the last thing I'm going to say tonight, guys. It's been a good 45 minutes. I love being with you. I'm going to sign off with this. There are different people on this webinar. There are different people out there on YouTube right now. You're listening to this. You might be listening to this 2 years from now. I'm speaking to you. You're a different kind of trader, right? Some of us are going to be really good at one thing over here, but some of us are going to be good at something over here. Blair, I'm just not wired for some of that really aggressive speculative trading. Okay. Maybe you're going to just do monthly credit spreads. Next week, we're going to look at something that we are going to build on this concept of a credit spread, and it's called an iron condor. And this is that's a crazy name. I know it's a funny name, but it's another strategy that's built off of using credit spreads that a lot of more conservative, what we call cash flow traders. You're not trying to do the big home run returns like day traders and picking direction. You're just trying to collect that premium every month. We're going to look at what that strategy is and get a little bit of an introduction on that as well. Of course, we can't go over the whole thing here. This is something that we do seriously in our programs. So please, if you are on here and you don't have any, Jeffrey, don't trade naked. Yeah. If you don't have any options training at all, right? You're really into this and you want to understand how do we approach this here at Tradeway. I'm going to tell you two things I told someone this weekend. Here at Tradeway, what do we do different? Which was her question to me. Number one, we don't look to trade. We are looking, I'll say it this way, we are looking for the skill sets that Wall Street has. We're just not looking for the values that Wall Street has. And the second thing I'll say is at Tradeway, we are looking to take care of our people who are just starting trading. Now we have advanced students. We can take somebody from any skill level. But wherever they're at, we're going to bring you into new concepts. And that is something that we are very, very good at, helping new people get into the world of options and understand it. And I'm grateful for some of the comments out there tonight saying that very thing, helping people understand this. Listen, if this unlocks in your mind, then it's unlocked in your ability. If it's unlocked in your ability, then you have potential that you didn't have before because we didn't understand it. And when we have potential that we didn't have before, we can have fruit that we didn't have before. And if we have fruit that we didn't have before, we can have impact and satisfaction that we didn't have before. And I'm not just saying this off the cuff. I'm saying this stuff can really make an impact. And of course, that's the goal. We got to teach you how to do it, teach you how to manage the risks, walk through the process. But I hope tonight was as good for you as it was for me learning about credit spreads, because I was excited for this one. It is a game changer understanding how to do this, and certainly important in the holistic, tool belt of a trader. So I appreciate you guys so much for being on here. We're back next week with Market Monday. If you know somebody who would benefit from this, go ahead, tag their name, like it, subscribe. Don't miss anything. Send it on over to them. Send them the link, and they won't miss it either. Appreciate you guys, and we will see you next week. All right. Good night.